Hello viewers, and thank you very much for joining me. Today we will be looking at this fantastic book, One Up on Wall Street by Peter Lynch. So we're going to take a look at the first part of the book with some of Peter Lynch's key principles explained, to how it can help us become better investors. Now, what Peter Lynch goes through is quite straightforward, and it proves that you don't actually have to have complicated theories in order to deliver excellent investment returns. So the idea here is if we can get an extra 2% investment performance over an investing career, say 35 years, 2% may not sound like much, but actually delivers a massive increase in performance. So on screen now, you'll see 6%, which is the bottom line, versus 8%, which is the top line. So a 2 percentage points increase in performance actually gives you about double after a 35-year investing career if you just start with a lump sum at the beginning. So all these kind of marginal gains, these simple principles, if we can just add a couple of percentage points to our returns, we can actually become a lot better off, a lot more successful in our investing. So that's the goal of this video. So the reason I've read One Up on Wall Street, I've got all my notes along the top here, is because of Peter Lynch. Now his record is incredible. Compound annual growth rate of 29.2% when he was running his investment fund. Just compare a sort of normal 8% a year return. You can see on the graph now, and compare that to 29% a year. Yes, 29% is about 3.5 times bigger. Your end result is somewhere in the region of 74 million versus 150,000 at the 8%. So it's orders of magnitude difference, which places Peter Lynch at that sort of top of the professional investor's pinnacle. He uses plain language in his book. It's easy to pick up. There's no sort of complicated theories. So it's a great place to try and pick up some tips. So because of that excellent record from Peter Lynch over a decent period of time, been really keen to hear what he's had to say. So that's why I've read One Up on Wall Street, and I now want to share with you what my takeaways from part one, where there are 4 things that I believe we could all learn from to become better investors and improve our long-term returns. So we're going to have a look at 4 of Peter Lynch's key tips and recommendations from the first part of the book, and I'm going to share those with you right now. So the first thing that Peter Lynch comes up with is around you don't actually need to have all of your stocks winning. Only 6 out of 10 of your stocks need to win, or your positions need to win, to actually produce a very satisfying result. And quite simply, the reason for that is your maximum downside is 100%. Now that's bad, particularly before Warren Buffett's rule number 1, don't lose money. So even if you had the worst case scenario, 40% of your positions lose everything, but the other 60% have an uncapped upside, so they can more than 100% and more than make up for the losses on the others. And that's not to say you should go and take unnecessary risk. What it is saying is no one can predict what will happen. You will have some positions that lose. Maybe your research was wrong or for factors outside of your control. Approach things in a proper way. You do your research and you're convincing your positions and you let your winners run, then yeah, 60% of your positions winning, you're going to do very well. So that's the first tip. Now the second one that Peter Lynch talks about is the good days in the market. And we've all seen them. We have that lovely green across the board. You're up 2 or 3% in a day. It looks fantastic. What Peter Lynch found is that staying in the market is the best recipe for most investors. The reason for that is if you take out your 30 best days over any decade period in the market, your actual return over that period is substantially lower. So you need to be in the market for when those best days unexpectedly happen. Your portfolio performance will benefit greatly from being in the market in those times. So second tip, stay in the market. Number 3, absolutely key one. If the stock price drops, you're down on a position, but the fundamentals of the business, the reason why you bought the business is unchanged or not materially changed, everything's good, then it's actually an opportunity to buy more. What you may hear about called averaging in or averaging down. So in mode is quite a good example here. So in mode run up last year to almost $100 a share, got all the way down into the 30s. So if you bought somewhere in the 40s or 50s, you potentially were 100% up at one point, and you're now actually down. If we have a look at in mode, they consistently beat analyst expectations. Revenue's growing, margins are really high. Fundamental story for this business is unchanged. So actually in that position, you may, if you like the business, consider adding more rather than being unhappy that you're now down instead of being 100% up. Just for full disclosure, I do hold a position in mode, and I have added more recently. And if you'd like to hear more about that one, great opportunity in my view, stay tuned to the end of the video. Tip number 4 is the mirror test, which is really analysis of yourself. It's all about mentality here, and so are you able to make decisions with imperfect information? You have the patience to weather the storm or to wait for that return to come along, even though others may be performing better in the short term. And have you got the ability to absorb pain? Really need to be able to absorb pain if you're going to invest in individual companies in the stock market. That is the number one mental test. At some point, if you have a portfolio with multiple positions, you are going to be down on a large proportion of those positions. Now, if you trust your research, you've verified, you've looked at different sources, and you're happy, you need to be able to sit tight and wait for things to play out. But also, you need to be able to understand if the fundamental position has changed in a business and the reason why you bought it is no longer the case and it's materially now degraded, then you might need to sell, potentially even at a loss if there's a better opportunity elsewhere. So you need to be able to take the pain and not just of waiting while things are down, but potentially of taking losses rather than holding something in the hope that it might eventually come back. So if you can do these 3 things, then you are very likely to have a good chance of being a good investor in individual companies. So those are Peter Lynch's 4 key tips in the first part of the book. Got some bonus ones coming up in a second. But please do comment below. So if you like this sort of video and you want to see me do part 2 and so on for the rest of the book, then I'd love to hear below what you think about it. But yes, there are several other tips in that first section of the book, and here are 4 that I've pulled out. So take advantage of what you already know, perhaps based on where you work or products you've used. Look for opportunities not discovered by Wall Street yet. You don't have the analyst coverage and the price acceleration. Ignore short-term fluctuations because, as Warren Buffett and Benjamin Graham have concluded, market is a voting machine of popularity in the machine in the short run, but it's a weighing machine based on fundamentals in the long run. And finally, predicting the economy is futile. Anything can happen. We've seen that in the last few years. So it's just try to predict what's going to happen. There's no point doing it because no one can predict that accurately, consistently over a long period of time. So that's what Peter Lynch has got to say. Now, if you're really interested in this book, One Up on Wall Street, and you'd like to help out some local bookstores as well as help the channel out, please do consider using the Finance with JCL bookstore, which is available for those in the US and the UK. And there's a link down below for that, and I'd really appreciate it if you check that out. Part 2 of the book is all about picking the winners, and if you want to see me do that, let me know. But most importantly, if you really want a good opportunity to make money for your portfolio with a growth stock, making massive margins, you can't avoid this video. You really need to check it out. Click the link on the screen now, and you may find a good investment for your portfolio.